Hello, I'm David Westin. Welcome to this Bloomberg television special, a conversation with Bank of America Merrill Lynch Chairman and CEO Brian Moynihan. As 2017 draws to a close, the head of the second largest bank in the United States invited me to his office for an exclusive interview. As it turned out, we spoke the very day that the House and Senate voted to pass a massive tax overhaul. We went into depth on his strategy for B of A, as well as his thoughts on financial regulation and monetary policy, and his forecast for global growth in 2018. But I began by asking what he's hearing from his clients about the economy here in the United States.
It's not as much what we're hearing, because that's more on the institutional side. It's what, on the consumer side, people are doing. And we see that every week. We get a roll-up of all what they spend money on. And so the spending year-to-date in 17, whether it's cash out of the ATMs or over the teller, whether it's checks written, whether it's bill payments, whether it's debit or credit cards used, is up 6% over last year. If you look at the equivalent period from last year to the year before that, it was only up 3%. And what is driving that is just people are spending more money. And so, interesting enough, checks written's gone up, and usually it kind of comes down because people write less checks. And so, yes, debit and credit card is the fastest sort of big number growing, but overall consumers are spending well. And when they spend well, that kind of drives the U.S. economy, because it's 2/3 of the economy is a consumer-driven economy, and they spend, and then companies sell them stuff, and companies that are successful, et cetera, they invest in their house. And so that's very good news for the U.S.
So where are they getting that money from? Are they borrowing more? Or are you worried about credit?
I'm not really worried about credit on the consumer side, especially for us, because we stay in a very high end. But even if you look overall, there was some concern about excesses in car lending, and that kind of got pulled back. There were concerns about, it hasn't been anything in the mortgage land, because we're still working through, the memories of what happened before, and the conservative structure of what the industry does and what goes on in lending. A little bit in some of the unsecured lending, student lending, not something we're involved in at all in student lending. We're not really worried about consumer credit. It's pretty good. But that consumer group spending drives our economy. And so in the U.S., we believe we'll finish this year, about 2017, about 2.1%, 2.2% GDP growth for the year, starting off with really zero in the first quarter. If you remember, it was kind of interesting. And next year we have that almost 2.5. And so that movement across this size economy is very big. The interesting question is the rest of the world's also growing. And this is the first time that you've seen Japan grow slightly, Europe grow a little faster in 1.5% range, China growing at 6%, India growing at 7%. These are those big economies all moving together is tremendously different than we were 3, 4, 5 years ago, where Europe was plus or minus 0, Japan was negative, China had come from a faster growth rate down, which year to year incrementally means they're slowing down. Now they're sort of stable, moving out. And India obviously went down and up. Those things in Brazil moved in and out. Those things are very interesting. So now you have this worldwide growth, and that's good for the world, and the United States helps supply that growth across the platform.
So you're looking at something like 2.5% growth in 2018. Is that before the tax legislation or after the tax legislation?
The tax legislation just got passed today, so it was not including any benefit for taxes. And our experts would say that would add to that. How much, 2, 3, 4%, 0.4%, to bring it to higher twos is probably what they settle on that.
So taking into account the tax overhaul, you're looking at something like perhaps 2.8, 2.9.
That'd probably be at the high end. I think they'd be more 2.6, 2.7. Because it takes a little while for all this to kick in. The habits are there and stuff. But the tax thing for businesses in America is a strong statement, and they're going to be looking to do things. And then around the world, you've got Brexit and some other things that create interesting questions. But right now you're seeing the rest of the world okay, and we have it growing at high 3s.
Do you have a sense from talking on the institutional side to corporations about what they're likely to do with the money? I mean, we've gone from 35% to 21%. There have been other changes that really benefit corporations, expensing of capital investment. Do you have a sense, are they going to return that to shareholders and dividends and buybacks? Are they going to invest that? What's going to happen?
Well, I think if you step back and think about tax reform at the corporate side, the goal always was to really get an effective tax rate in the United States, which was competitive with the world. And what they were doing when we were in the mid-30s and the rest of the world was 20 and 12 or something like that, is the money was being shifted to where final demand is. This whole huge world of billions of people that are outside the United States that buy things, the ability to manufacture, ability to access the raw materials. So they were shifting their investment dollar over. That I expect to reverse a bit, and because we're now competitive. That was the core principles of the corporate side tax. when you talk to them about what they're going to do, my guess is you're going to see a little bit of everything. You're going to see some people buy back more stock because they have more after-tax profit. Some will invest in the business and build things faster than they would have otherwise. Some will fundamentally rethink their balance between inside the United States, outside the United States. None of this can be bad. None of this can be bad because the money will go back into circulation if it's share repurchase or dividends, and the people who have it will have to go back out and invest it. If they invest in buildings, equipment, and things like that, that'll create jobs to build them. So when you think about us, we'll accelerate some things we were thinking about doing. Maybe a little more technology spending, maybe a little bit more on the branch side. We're building out hundreds of branches in markets we weren't in. Each one of those has 10 employees, but importantly, to build it, each one is a several $million construction project that has to be done locally in cities like Indianapolis and Pittsburgh and Cleveland and Columbus and Cincinnati and Minneapolis and Denver. That'll create jobs, and it will create jobs and pressure on wages that will help wage growth. And so in this connected economy, anything that gets people being slightly more aggressive is good.
Bank of America particularly has an orientation toward the consumer, to the individual household. When you look at the tax overhaul, do you see a changing behavior of individuals? Things like mortgages, borrowing money for cars. Do you see it changing that in addition to whatever change it has for the C-suite?
In some respects, we don't know because $750,000 in mortgage deductibility. Interest on mortgages at the high. If you look at it, the average mortgage is $200,000. So,
yeah.
But it's going to affect a group of people that are borrowing $1 million for their home, and so this is going to have a lot of different effects. And we'll see it play out. But by and large, our middle market group of companies, the 30,000 of those and the 100,000 plus, smaller businesses we have, they believe this is a statement that the government's in it to help them be successful. It's pro-business. That will be helpful because that'll drive demands, employment, and I think ultimately wage growth and investment and all that stuff we were talking about earlier.
There are going to be some real changes in the Fed next year. We're going to have a new chairman. We're going to have several new members. How different do you think it's going to be? Is it going to be pretty much continuous with what's been before, or do you anticipate some changes?
Well, I think on the monetary policy side, Governor Powell and the chairman, that's up for the appointment. I think he's been clear you won't see big breaks there. I think on the regulatory side, it's more captured into the general regulatory effort, which the Secretary of Treasury Mnuchin and has been leading, and the white papers they put out are roadmaps to sort of rebalance. We are for, importantly, good capital, good liquidity, and scope of activity regulation. At the end of the day, the banking system through the FDIC insurance process guarantees the solvency of the banking system. The government pays first, and we fill up the trust fund, and we do that, have forever. So if you're the size of deposits, 10, 13, 14%, whatever we are, that figure, we are most interested in having regulation be right. And by the way, my colleagues in the same point. So we're advocating, let's get it right. Now there's a bunch of stuff that we believe it's inconsistent with each other, it went too far, it takes too much time, things like that we can bring back in. A little bit to make it more safe and sound. And by the way, we leave the burden off the small banks at the same time, which the bill in Congress is working through the system. There's different approaches to it, but hopefully that'll get through because they're not going to create the threat the perceived threat. And so at the end of the day, we've all doubled our capital, quadrupled or more our liquidity, reined in the scope of our activities, and reduced our risk, and you can see it in the stress test, which is a good regime for people to test whether they're doing it. Those are all good things, so that should stay. There's a lot of nickels and knitting and in the weed stuff that would shock people that we can take out and not reduce the safety and soundness of our industry. And we are the most safe and sound industry of anybody in the world by far. And it's proven by how you look at the various methodologies of measurement now.
Still ahead, Brian Moynihan shares his global outlook for 2018. Prospects for growth seem strong around the world, but there are some clouds in the forecast.
The big wild card is how Brexit will fall out, and you just don't know because they're negotiating as we speak.
And up next, how B of A is meeting business challenges, from managing risk to its approach to FICC trading in a low volatility world.
We are a big fixed income player because we have the big issuing clients and we have the big investing clients, and we match them together and bring them together.
This is Bloomberg. I'm David Westin. Welcome back to this exclusive conversation with Bank of America Chairman and CEO Brian Moynihan. He's laid out a strategy for his bank that he calls responsible growth. And to judge from the company's earnings and stock price, it's paid off for him in 2017. I asked him to assess how responsible growth has worked so far and explain how he plans to keep it going.
So the first thing, we have to grow, no excuses. We have to win in the marketplace. We have to be successful for our clients. The second part of responsible growth is we've got to do it on a customer-focused basis. It's illegal in the United States for us to make an acquisition. We have no desire to make acquisitions, so it's all organic, customer-driven. The third part's the risk, manage the risk well, and that's in good times you have to be more careful at managing risk as well as in bad times, because in bad times you know what the problems are. And so in the good times it's a question, what could the problem be, and that's where you have to manage it. And the fourth is we have to be sustainable. And we talk about being sustainable, having the best pace for people to work, our team, our communities, sharing success with communities, and then having operational excellence. And getting all that to work is what we're driving at. And so if you think about it, if you think about us going forward, what are we going to do? We have a consumer business, retail, which, core checking accounts, credit cards, mortgages, home equity loans, auto loans, and we're just driving that through. Providing better and better client service, more and more technology, more locations in places we weren't, and you keep investing in the business and materializing on the scale and capabilities, all the while the cost of operations is coming down. That's what operational excellence is all about. How do we continue to take out costs because of historical inefficiencies, customer change of behavior, automation, digitization, all that stuff, and just drive it through. And that's what we're going on. You get in the wealth management business, #1 in the business in the United States, and how profit and revenues and all the different ways you count it. Great brands, U.S. Trust and Merrill Lynch. But the question going forward is, how do we now deal with the revenue compression and the automation of the practice in the broadest context, which people use the word robo-advisor to describe it. And how do you make a financial advisor the ability to do more and offload more of the work for them so they can be more successful and spend more of the time working with the client as opposed to working in the back trying to think of how to move the client's assets around, things like that. More planning, more needs-based and stuff. When you go to the corporate side, we have a tremendous commercial business, whether small, medium, and large-sized business all over the United States, globally on the high end. And the job there is, helping support these clients and helping them grow, but there's tremendous opportunity for us to do capital markets activities for our mid-sized clients that our market share is single digits, and it should be multiples that. And those teams are working on that, so how do you deploy there? And then you go in the corporate investment banking markets. Markets will be a business where we'll always invest in, and we're one of the top players in it, but it will be constrained a bit by the amount of risk we're willing to take, and we want it to be more stable, and Tom Montag and team done a great job. I look back, and if you sort of project out this quarter's revenue in that business, it's basically gone between 12.9 and 13.6 billion for every year. And so it's not really moved up and down like people said. Now, you compare quarter to quarter, and so he's stabilized, and the team's done a great job. But really, it's all about driving, operational excellence to keep reducing the cost and automating that business. And so each of the business has those four tenets going through it.
So let's talk about trading for a second, because you brought us to that. FICC trading right now is sort of almost an existential question for the major banks. We hear it all the time. Every quarter we look at that carefully. Are you saying that basically we don't need to grow the top line in that, because doing that might incur more risk than we're comfortable with, but we can increase profitability through reduced risk? Is that the strategy?
Our risk from 2010 to now in fixed income, it were 10% of the risk level. And if you took today's portfolio and put that volatility from 2010, it'd still be four times less. And you're making as much revenue or more. And so it's the throughput of which we do. It's moving stuff through the system as opposed to having big balance sheets that you're storing assets. And that's by the way, it's same is true in equities. And so that's what we're driving at. We are a big fixed income player because we have the big issuing clients and we have the big investing clients, and we match them together and bring them together. And then, but you got to automate that business. So Jimmy DeMauro and Bernie Menza and the team that works on it, they are bringing to that the electronification, just like we did in the in the equities business across time, and so they have ability to trade whole loans by getting bids around the market. Think of the early NASDAQ market making days in equities. They're just doing that in whole loans through an automated bidding system that they've built, and so people can see. So it's not only the ones we have in that we originate, but other people originate, so you can do it. So you get in these very important ways you improve the profitability of it without necessarily growing the top line beyond what the market's going to give you as it generally grows and as it generally ebbs and flows with volatility and what's going on. People rushing to issue, not rushing to issue. And that's what you're trying to follow. You're trying to follow the market and the clients, not create independent risk that you're taking. That's the way we run that business, and they do a fabulous job of doing it.
Technology, you've been a big proponent of technology. You've really brought it into Bank of America. Are we looking at a future world where we essentially have Alexa instead of our investment advisor for Merrill Lynch, for example?
Well, again, you have to back up a little bit. And since I've been CEO, I had somebody look this up the other day because I was doing something else. We're about $25 billion in coding in the 8 years.
Wow.
And so you start to think about that. That's a lot of feature functionality, improvements, and everything going on. But it's the nature of so it's about $2.5 to $3 billion a year, and it's a little higher when we're doing mergers and stuff. And the idea is that we're a technology company. We're basically a very talented group of 200 and some thousand teammates in a bunch of huge computer technology systems and then analytical frameworks that work on it too. And that's what we do.
You've gotten some attention, on the street at least, right, by announcing sabbaticals in part of your operation. Why are you doing it?
Well, we're always, so if you go back to being sustainable and responsible growth, the fourth tenet, one is to have be the best place for people to work. We measure that by our pay for performance, by our diversity, by our volunteer work, by our wellness activities, by our benefits package, by our leadership development programs, by the involvement we have in our people and all the things they do. That's all part of it. One of the perceptions, one of the requests came up is saying, hey, my kids are going to go to college next year. Can I take an extra month off? And so Tom Montag and his team in the GBAM, it was particularly acute there because the nature of the business, the nature of the production of a lot of the teammates. And so he developed it, and he's put it in, and it's become effective now. So that person could do that in every 10 years, 15 years, 20 years, et cetera. You get 4 weeks, and it builds from there. And we just think it's a chance to recharge our batteries and refresh people and give them a flexibility to do something they might not otherwise done.
Coming up, my exclusive conversation with Brian Moynihan continues. We discuss uncertainty over Brexit, China's daunting debt, and what's next for him as CEO.
We can't change everything. It's a big world out there, but the things we touch, we can affect. And to me, so that's not new. That's not something we change. It's not something we're doing different. It's just that we have to stick to it.
This is Bloomberg.
Get the edge you need to stay ahead. Subscribe to Bloomberg Businessweek and receive 4 bonus issues free. Bloomberg Businessweek delivers in-depth reporting and provocative perspectives that take you inside the news each week. Bloomberg's 2,400 journalists worldwide dig deep for stories and insight you can't find anywhere else. Take advantage of this special offer. Order now to get 4 free bonus issues of the only business magazine powered by Bloomberg. Go to businessweekmag.com/TV offer.
Welcome back. I'm David Westin. As CEO of Bank of America Merrill Lynch, Brian Moynihan is always looking forward, and there's a lot for him to ponder as 2018 approaches. Investors will be watching Europe closely as Brexit negotiations continue. And in Asia, the government of Xi Jinping is reinventing its economy, but taking on huge debt in the process. Here's what Brian Moynihan sees on the horizon.
We see it as in the mid ones, and you see, 1.25, 1.5 type of levels. We think it's fairly fundamental. You think it's caught up with itself. The restructuring of the financial sector is through, and it's not going to be a lot. It's not going to hurt the economy. So we feel fairly constructive. The big wild card is how Brexit will fall out, and you just don't know because they're negotiating as we speak. And you read the paper one day, it's going to look like this, and the next day it's going to look like that. It's hard because this is trying to take in a short period of time and rewrite, tremendous, 35, 40 years or whatever of history of how they came to this point and instantaneously change it. So I think nobody can predict the outcome of that. I don't think it's good overall for Europe because it was kind of moving along and just, people were spending a lot of money figuring out what to do as opposed to spending that time trying to help clients and customers, and they're not going to get anything more out of this. And so I think it's a negative, but I don't think it's a strong negative as long as it's managed well by the policymakers, and I think they're trying to do that. There's no incentive for them to make this thing screw up their growth rate, and so we feel pretty good about Europe.
China. China has had really steady growth. They seem to have managed it pretty well. At the same time, they've got a real credit issue. They've borrowed a lot of money for that growth. How do you see China over the next year or two in terms of their growth and how they handle that credit issue?
Well, they're working on it, and our team, our research team, which is one of the best in the business, has them growing between 6 and 6.5, and sees that go on. And it's that fundamental urbanization, industrialization, pulling people into the economy. They got to create a lot of jobs, and that takes a lot of work. And so I think, and they're working on the debt side and the shadow banking, all the things, and you see the policies change. And so it's not news to them that they've got to figure this out, and they're working at it. It's just you're trying to engineer that change without slowing it down too far, and that's the tension that goes on. And I think so far there's been times when the world doubted that they could do it, and they seem to keep popping along. And so it's the second largest economy in the world. To grow at 6% is actually not a bad outcome for them.
It's the second largest on its way to being the first. It's a big potential market for Bank of America. In the past, you've had some interests there to perhaps have backed off a bit. Now China's saying we want to really liberalize. We want to welcome in U.S. banks. You're going to own more than 50% of some of the entities here. We want to have access to our capital markets and things. How big a priority is that for Bank of America going forward?
I'd say it's outside the United States, we do global corporate investment banking and markets, and we already have that in China today. We are then moving along to do a couple other things there, what we call local incorporation, which allows us to do more debt capital markets inside the country. On the equity side, we don't have any plans there. We do a lot of that out of Hong Kong and incremental activity. It's not clear how much is there for us today. But it's always going, because it's growing, because it's big, it's always going to have more activity. So we do a lot of lending there, a lot of cash management there, a lot of work for our U.S. companies and other global companies in there to help them go in, and then for the Chinese, large companies. So it's a good market for us. We have several hundred people that work inside there, a lot of people in Hong Kong that support the operations. But it will not be a retail bank. There will always be an institutional situation, and then we'll be careful about when we make the steps, because steps to equities and stuff, there just hasn't been a lot of chance to make a lot of money. We have to figure out if it's really there.
You've accomplished an awful lot while you've been at Bank of America. It's a very different organization from the day you took over CEO. For whatever time you have left, 20 years, 30 years, whatever time it is, what do you want to still get accomplished?
Well, I think that we have the capability to serve three groups of customers: people, companies, and institutional investors, in ways that we haven't even thought of yet, that are fair to them, fair to our shareholders, and have our teammates have great, successful careers. And on top of that, because we can do it and do it well and generate profit, we can actually create the societal changes that we're capable of. We can't change everything. It's a big world out there, but the things we touch, we can affect. And to me, so that's not new. That's not something we change. It's not something we're doing different. It's just that we have to stick to it. Because if we lean too far on just trying to make money for our own sake, that's when this industry gets in trouble. It becomes about us and not about the clients and customers. If we lean too far and forget that our teammates need to participate, we have a problem there. If we lean too far and overlend, consumers have a problem. And you can think of all the different ways that that's played out. So our job is to run this thing on responsible growth. But it'll always look different. There'll be some technology you and I can't fathom will be out there. But if it starts from that basic reason why we're here, to serve our customers and clients and help them live their lives, and then we grow within our sort of right risk and right way, and then do it balancing the investment in the future, short and long term, it'll be fine. It'll be good. And if somebody wants to do something different, fine, but that's what we're going to do.
That wraps up my exclusive conversation with Bank of America Chairman and CEO Brian Moynihan. You can see even more of our interview at Bloomberg.com, along with all the latest business news and analysis 24 hours a day, 7 days a week. Thank you for watching. I'm David Westin, and this is Bloomberg.